Why are clean financials and the preparation of them so important in a transaction?
Yeah, that's a great question, and I think if you think back to applying for a job before we had our companies, right? You go and you apply for whatever job that may be, and if you were to handwrite that application and put a resume C attached, it's not going to be looked at as favorable as a very professional typed resume that lists all of your experience and your education, and just put together in a very professional format, right? If you have those two next to each other, you're going to go with the professional format, right? That's who you are. And the same thing with financial statements. If they're not prepared professionally, and there's mistakes in them, then you lose trust. And once trust is lost, the deal is lost.
Yeah, I mean, we really see them as the keystone to the transaction, especially when you're approaching it from preparing all of the listing materials, particularly the Confidential Information Memorandum and the SIM, and the backbone of the deal of what you're going out to market with is this set of books, right? And that includes P&L and balance sheet in its most basic form, and then a statement of cash flows, hopefully. What we end up doing, and it's part of what we collaborate with you on, is we essentially say, okay, what does this look like from, usually it's in cash basis. I mean, maybe not so much these days with some of the larger deals, but usually it's in cash basis with these service providers.
Yeah.
And then we're looking at it from an accrual standpoint, so that we want to reconcile a period, right? And then we want to have those periods reconciled, ideally on the monthly. And then we also get a lot into the adjustments on the cash flow, right? Or what we term EBITDA. And we've done a lot of videos on EBITDA and what it is and what it means. But one of those areas is you can come in there and you can look at these adjustments and you can say, hey, these make sense. The ultimate number that we get to in terms of an adjusted EBITDA number, that does make sense, because that right there is the base variable for us that we then add the multiple onto. And so, it's sort of not only just the SIM and all the materials and going out there with your financial resume, as you're saying, but it's also that the way that we can respond to an offer is with these valuation metrics, and that really is the core of it. So, I mean, speak to how you've worked with clients in the past on getting to those numbers, and making sure that we're going out with numbers that we might think that a certain thing might be an adjustment, like for instance, the certain ownership salaries. But if the ownership are going to stay involved, or if they're going to have to replace that person because they're operationally doing the day-to-day, then there's a lot of that back and forth that needs to happen. Where have you gotten involved in that?
Yeah, I mean, primarily what you're describing there, that's a typical conversation that I'll have with clients too. And one of the questions is, look, I'm leaving. Even if they are leaving, they don't need my salary comes out of it. Well, that's true unless they have to replace you, right? So if the owner is doing a lot of operational work, then that's got to be replaced if that owner leaves. If the owner is an absentee owner, that's a different story, right? So you've got to dig into those and understand what those add backs are and why they're add backs, and be able to justify them, right? So an owner's car and the owner's going away, that makes sense, right? You don't need to replace the car, but certainly the salary may or may not be replaced, and so that's something we'll typically talk about.
What are some of the oddest add backs you've seen, or some of the ones where you're like, this is a little gray?
Yeah, well, typically you'll see some things that should have been in there to begin with. That's my ski trip every year. That's that's not related to business, and so instead of it being a distribution, it shouldn't have been in the financials to begin with, right? So we would just assume take them out rather than and restate the financial statements rather than have them in there and have an add back and explain why they were in there to begin with.
Right.
because then it goes back to the integrity of the financial statements.
And you don't think that your clients see patients on the slopes at all? In the gondola?
You
Yeah,
never know.
that's my office, mobile office.
Yep, there you go.
That makes sense.
Yeah.
Where are you most focused when you dig in on financials? And the reason I ask that is because sometimes, look, we have clients who, again, operate in the small business community, right? And there's a pretty big range there. You have larger clients as well,
Yeah.
but primarily all of our clients are in that, I would say, sub $5 million cash flow area. And some of them have gotten that way because they've been very frugal, right? And a lot of them are also self-directed, and they believe that they have the agency and capacity to sort of do these things on their own, right? And I don't want to take any of that away from them and argue their capacity. But do you find that you get into situations where you say, look, this is not where we need it to be? And how do you work through something like that when you say, well, I don't want to spend money on, someone comes to you and says, I don't really want to spend too much money on this. Just look at if there's anything that's big or any big problems. How do you kind of come back to somebody like that with, and understanding that you do want to work with them, you do want to help them. How do you work through those kind of challenges?
Yeah. So, I mean, I think the first thing I do is I like to see their tax return. I like to see their financial statements, make sure they tie, right? When we typically look at the financial statements, we're focused on the balance sheet. The income statement, that's important. Typically, your deposits are your revenues and the cash basis. Your expenses are what they are. They may be miscategorized. That's okay. They're still there, right? But your bigger issues are going to be on the balance sheet. So we can quickly skim the balance sheet and say, okay, do we have assets that are no longer there? Do we have negative assets? For example, is accounts receivable? I've seen accounts receivable that should have a positive balance be negative. I've seen loans that are positive that should be credits. So looking at all of those things and just simply saying, look, it's going to take some time. Here's your options, right? You may not want to spend the money to do this, but this is what it would take to fix it. It's up to you. And so I just kind of push that back on the client, let them make that decision. But if they want to get it right, they want to get it right. And typically, if you get it right, you're going to get a much bigger valuation.
No, it's a great point. And we get into these situations where folks have been running their businesses for decades, and they say, well, we've never done this before. The person that's going to buy us is going to buy us because they want a certain profile of the business that we offer. There's all this value in the operations, and the financials don't really matter, right? Like, their perspective on it is, I've had a tax accountant that at the end of the year, I dump a whole bunch of information onto them, and they come back and they give me a number, right? And some returns, right? That's been their experience. And so again, I'm really focused in on the lower middle market here. But do you find that, how do you change someone's perception? And again, we've touched on this, but how do you change someone's perception that comes into it with that mindset?
Well, I typically will explain to them, look, you've got to put yourself in the buyer's shoes, right? If you're the seller, and if I'm buying a company, and I have, right? I talked about the fact that we purchase healthcare companies. I've purchased CPA firms and merged them in with my own. I want to look at the financial statements, get comfortable with the financial statements, and then determine how long it's going to take to get my money back, right?
Mm-hmm.
If I'm going to finance this deal, if I'm going to pay cash, whatever that happens to be, how long is it going to take to get that money back? And if it's a long period of time, no one's going to want to touch it. I don't care how bad they want to be in that market, right? So it's got to make sense. And so that's kind of the typical way we'll talk to our clients about it.
Do you think that I frame it properly when I tell clients that someone in your capacity that's looking at it, and I'll call it transactional accounting, okay? That someone from your perspective is actually almost doing the opposite of what a tax accountant is doing. You're looking for all the areas where the company has value.
That's right.
You're trying to increase the income based on the actual performance of the business. And you're also saying we have metrics now that we can point to, because for us, death is in the business that goes to market and has a decline while in process. So, we started off and we had a certain amount of cash flow or a certain performance. And then, 3 months later, when we're going through diligence, the business is performing lesser than when we went out to market. Like that is probably the worst case scenario for us.
Yeah.
So, do you think that that's the right characterization, just to say that this is a whole new ball of wax here? Like, this is someone that's going to come in and look at this in terms of maximizing value, as opposed to somebody that's trying to show the least amount of income from a tax perspective.
Yeah, we had that conversation, years before the deal. Sometimes, we'll have clients that will come to us and say, look, we want to sell in 24 months, 12 months, whatever that happens to be. We want to maximize our value. Well, that's a different answer than minimizing your taxes, right? Minimizing your taxes, we have more expenses. We're looking at opportunities to reduce that, spending more money that may be needed for the business, buying equipment, for example, things like that. Whereas if you're looking to minimize that value, you want the highest profitability you can, so that the buyer looks at it and says, based on that profitability, the payback I'm going to get on that deal is going to be much lower, right? The time period to get my money back. And so they're counterintuitive for sure. And I think you categorize it perfectly.
Yeah, no, it's a challenge, because there is a certain experience set with their books and how they've handled them. And we're saying we have to. This is a one area where we're gonna need to invest and spend. And like you said, it's nice to have the runway. I mean, we always talk about if you're even contemplating going out to market, have a conversation with someone that understands what the M&A process is like. We talk about sort of framing what the expectations are for our clients a lot as well. And given your healthcare experience, are you able to also validate valuations potentially for them, or look at other areas in the market where we use a transactional multiple, right, to add or to multiply against the EBITDA? And, essentially that we look at that number as like, how many years will it take for the buyer to make that EBITDA back, and sort of make themselves in some respects whole relative to the enterprise value. And so our valuations range from, probably we're not going to go out to market with something that's too much lower than 5. And then there's some areas, segments in the market that might be upwards 10 to the low teens, 10 to 12, right? Can you come in there and say, look, this makes sense to us, so that they can get another opinion on how we're going out to market and framing their expectations?
Yeah, I mean, I would have a conversation with the client from an experience perspective. It wouldn't be a formal opinion, though.
Right.
But I'd be happy to have the conversation for sure.
Yeah, I think that's the thing, is that we can also do formal opinions of value. We can do valuations that are in a report form, witness testimony type situations. A lot of that happens usually when there's a partnership that's looking to break apart. And we've worked with restructuring companies in the past as well in that regard. But I think that from the perspective of how it looks, and how this will feel in the market, it's always nice to have somebody that works with these types of companies that can come in and say, hey, that I can say, hey, look, talk to Doug and see what he thinks about this. But framing expectations is important to do early in the process as well.
Absolutely. Yeah. And I think to your point, you have the experience here. You're closing transactions. You have a lot of clients that you've been through this with. And so from a high level, what these entities are going for on the market, right? You just know that from your experience. And so, look, what anyone's willing to pay is what is what it's worth, right?
Right.
So you want to get as much as possible, but you know what's reasonable. And so I think that's invaluable, even without a formal evaluation. The market.
Yeah, and you bring up a great point because we see other forms of valuation out there, right? Maybe some form of income or asset analysis or a discounted cash flow analysis. And I'm not taking anything away from the folks out there in the industry that do these, but a lot of it is not relevant to what actually happens,
Yeah.
where you get into a process. And what we find is that there's a buyer that comes in that's usually higher on the bell curve of deals, of offers, right? So we get an offer, let's say we get 4 offers. There might be 3 offers that are hovering around the same area. Then there'll be that one offer that's 20 to 30% more.
Yeah.
And, I would say that the most important piece in keeping that offer that high through the whole process is getting through the quality of earnings.
That's right.
Because the reason that the business saw you as being valuable is because of geographic synergies, or there's a caregiver population that you have, and usually those things end up panning out. I mean, there'll be clinical analysis, right? But it's usually that those areas pan out. That one area that we're always at the edge of our seats on is, okay, well, how's the Q of E coming in? I'll tell you, you go into a process and you've got reviewed financials and you know what you're up against in terms of the quality of earnings, and it just makes it so much more seamless getting through that. Has that been your experience?
Absolutely right. Yeah, I mean
Yeah.
that's your biggest hurdle from a financial perspective, right? And so, if you can go in there and sleep at night knowing that they're solid, knowing that you've had a CPA review them, I think you're way ahead of the game for sure.
Okay, great. Doug, again, another broader question is, how will a transactional CPA improve the value and probability of a successful sale?
Yeah, so I think it goes back to a lot of what we've discussed already, in that clean financial statements are going to give you the highest value, right? It's going to give you the trust that you need to command a higher price, and they're going to be accurate, so that where you should land.